We now continue with our final part of this particular unit, which is going to be on the risk measures around portfolio. And we'll try and now incorporate the risk in some sort of return calculations while looking at any kind of portfolio management data. Right? Let's explain the understanding on this one. So what we are saying is we are trying to kind of arrive at some number. Let's start with a simple question, like consider two portfolios. Portfolio one giving a return of 32% in first year in a year, while portfolio two giving a return of 22%. Which one is better? Now, when you look at a question like this, the first answer that would come to your mind is probably portfolio one is better. And that's what most people will choose in general as to what is the correct answer to that, right? But in reality, this is an incorrect assessment unless we have looked at what was the risk that was taken in order to achieve those returns. What if portfolio one was a very concentrated one? What if portfolio one had 20% weightage to a single stock? What if that bet went wrong? Right? So if that stock that had huge weightage in the portfolio had not gone up and had gone down instead, this 32% could very well have been 12% for all you know. So unless we know what is the extent of risk taken in the portfolio, unless we know what is the risk to return sort of ratio that we're looking at, or the relationship between these two, we cannot say which portfolio is better. In order to say which portfolio has performed better, we need, in addition to the returns, we need to understand what is the risk that was entailed in that, right? And the relationship between risk and return from an investment perspective is direct one, right? If you are investing in a high risk investment, it's expected that you will be compensated by higher returns, right? So if two funds have given 20% return each, but one has taken higher risk than the other, then you don't like that, because if you've taken higher risk, you would ideally want a higher return as well, right? Risk adjusted return relates the return from an investment to the risk taken, and it tries to kind of generate the return from the crux of what was the risk taken there, right? It indicates that the investment was able to generate a higher return for the risk taken or not. Two of the most commonly used metrics are Sharpe ratio and Treynor ratio. These are the two commonly used ratios to measure this. The return number used in the calculation for risk-adjusted return is essentially the excess return. How do you calculate the excess return? Excess of the investment return over generally the risk-free return, right? We will probably discuss risk-free return in some other course at some point of time, but essentially your excess return is the return that you have generated on the portfolio minus what you could have generated using just the risk-free instrument. That's the return for which you should have taken any risk, right? This is the excess return over and above a risk-free rate of return. You will make risk-free rate of return without taking any risk, right? And typically the risk-free return is government bond return in the local currency, right? Domestic currency. Now you will try and compare this to the amount of risk taken. So let's take these one by one. Let's take the Sharpe ratio first, and then we will look at the Treynor ratio. So what does Sharpe ratio say? It says that you have a portfolio return and you have a risk-free rate. That's the excess return you have generated. To generate this excess return, you would have taken some risk. Risk, we have already seen, is kind of specified as standard deviation in the context of finance. So standard deviation of the portfolio is the risk you have taken in order to generate this excess return. So what you are trying to find out is what is the excess return you have generated per unit of risk taken, right? And obviously you're looking at a scenario that higher the better, right? So the Sharpe ratio, it gives you the expected or the actual return, it calculates the expected or actual return on the investment. It subtracts the risk-free investment's return from the expected or actual return and then divides that number by the standard deviation for the investment, The primary purpose is whether you are generating a significantly greater return and whether you are doing it in exchange for accepting the additional risk inherent in equity investing over and above the risk-free returns, risk-free instruments, right? That's an important metric because essentially, if you take too high a risk, but you do not generate a commensurate return on the portfolio on that, that is not considered a good portfolio. So 32% is considered better than 22% only if the risk taken to generate 32% was not significantly higher than the 22% thing. In our earlier example, let's assume if standard deviation of portfolio 1 was, let's say, something like 24%, or let's say standard deviation of portfolio 1 was 32%, whereas that of portfolio 2 was something like 14%, right? Assume risk-free rate was 8%. So we are saying RF is equals to 8%. So what is the Sharpe ratio of portfolio 1? That's the return it generated minus the risk-free rate divided by the standard deviation. That's 24% divided by 32, which is 0.75. What is the Sharpe ratio for 2? That's 22% minus 8% divided by 14%. So that's 1.00. So for every unit of risk, the second portfolio created 1% of excess return, 1 unit of excess return, whereas the first portfolio only created 0.75. So in this context, SR2 is considered better than SR1 based on the Sharpe ratios, right? So effectively, Sharpe ratio tells you that for every additional unit of investment standard deviation that you're taking, what is the excess return you are generating? And obviously, higher the better. For the same standard deviation in two portfolios, the one with higher return is good. For the same return on two portfolios, the one with lower standard deviation is going to be better. That's going to give you the higher standard, the higher Sharpe ratio, right? Then we look at something called as the Treynor ratio. So rather than measuring a portfolio's return only against the rate of return for a risk-free investment, the Treynor looks to examine how well the portfolio outperforms the equity market as a whole. What do? Instead of sigma, you change it to the portfolio beta, right? And once you substitute beta for the standard deviation, this essentially tells you what is the excess return you have generated by taking only the systematic risk of the portfolio by creating this portfolio. In a way, Treynor ratio will replicate what Sharpe ratio gives you broadly. In 99 out of 100 cases, they will give you the same directional returns. If fund A has performed better than fund B on Sharpe ratio, it is likely that it would have performed well on Treynor as well. But Treynor in a way also gives you an idea on which fund is better diversified, right? So to generate the same return, which fund has actually taken a lower beta, right? And that's if it is more diversified, it has less systematic risk essentially. And that is where Treynor ratio becomes more useful, right? But in general, both the ratios, Sharpe and Treynor, and Sharpe is the more commonly used one and quoted one, are trying to tell you what is the excess return you are generating on a unit of risk taken. That unit of risk for Sharpe is standard deviation and for Treynor is portfolio beta, right? Now, standard deviation we've already studied. It's a measure of dispersion of a set of data from its mean. More spread apart the data has higher deviation. Standard deviation is calculated the square root of variance. So if a fund has a normal return, and this is the chart of the return distribution, versus another one which has this chart of return distribution, the one which we drew the second time, the dotted one, has a higher standard deviation. It's a higher variance fund because you have seen multiple values which are on extremes on either side of what is the mean. So it has a bigger dispersion, right? And standard deviation is nothing but the under root of what is called as variance, right? These are concepts we would have studied elsewhere. It's useful for us to kind of understand what the data is, and it's typically useful when we are looking at what is the normal distribution, right? Where we are saying that stock returns are expected to be distributed normally. And when we kind of create this, we say +1 standard deviation, +2 standard deviation, and so on and so forth. And what is the range of data that we find, right? We don't need to get into too much detail of this here, but understand that standard deviation is a measure of total risk of any investment instrument, right? Let's take a case. Following is the data for small and mid-cap funds, right? Small and mid-cap funds. What are these? These are small companies and mid-sized companies, and we are looking at performance of these funds over the last 6 months, 1 year, 2 years, 3 years, right? And this is sorted on the basis of 3-year returns. This is where it is sorted. We also have the standard deviation for these available here, which is in the form of volatility data, right? Now let's look at two funds which give almost a similar return, right? Let's look at this fund and let's look at this fund. They're giving almost a similar return, but the second one, which is Franklin India Smaller Company Funds, has a lower standard deviation than the first one. So logically, if you were to calculate Sharpe ratio for the second one, that's 38.7% minus, let's assume risk-free rate is 8%, divided by 14.5, whereas for this one it will be 38.8% minus 8% divided by 17.8. Logically, the numerators are almost the same, but the denominator is higher for the Canara Robeco Emerging Equity Fund for that particular period. So for all practical purposes, this is the underperforming fund. Which fund would you choose? You would choose this one based on Sharpe ratios that you have calculated, right? Similarly, you could claim that this return looks remarkably good or higher than 38.7, but unless you take 46.4, subtract 8% from this and divide it by 18.2, and you compare 38.7, subtract 8% from it and divide it by 14.5, this is Sharpe ratio 2, this is Sharpe ratio 1. Only once you calculate this data is when you will be able to definitively say which fund has done better on a risk adjusted basis, right? That's basically the case that you are trying to look at. That's basically the solution you're trying to look at. Whenever you look at funds, don't just concentrate only on the returns that the fund has generated. It is important to understand what is the risk that the fund has taken, right? And when you look at that risk that the fund has taken, then you try and identify what is going to be the Sharpe ratio for that fund. Higher the Sharpe ratio, better the fund. Higher the Treynor ratio, better the fund, right? Let's take another example. Let's say an investor is considering two investment options, option A with a mean of 15% and option B with a mean return of 15% as well. So these are the mean returns given to us for both the cases, and the standard deviation option 1 is 3% and in option B is 4.5%. As an investment advisor, how would you explain the risk in the investment using this data, right? So in the first case, you have 15% return minus the risk-free rate, whatever the risk-free rate that is, and you divide it by a standard deviation of 3%. In the second case, you have 15% minus the risk-free rate and you divide it by 4.5%. This is Sharpe ratio 1, this is Sharpe ratio 2. Which is better? Right? We know that Sharpe ratio 1 will be greater than Sharpe ratio 2 because you are taking lesser risk to generate the same return, right? So effectively, as an investment advisor, you would want this particular investor to choose fund option A, right? So that's how we solve this question. And as we come to the end of this particular unit, couple of questions. Explain why risk-adjusted returns are important. Give an example how you can explain that. And explain the difference between Sharpe ratio and Treynor ratio, largely on the basis of formula. Thank you.